This is Steve Masiello. I'm a partner in the government contracts practice group within Dentons, and I'm very pleased to present another session in our Dentons Government Contracts Academy. And I have with me some trusted colleagues and with Chess Consulting to talk a bit about the general accepted accounting principles that intertwine with government contract cost accounting. And I'm very pleased to talk with you today, and thank you for joining. But before we get started, we have a few housekeeping issues to address. First, for the benefit of all participants, attendees' lines have been muted. Should you have any questions and you'd like to submit them during the event, please feel free to submit them to the Q&A or to the chat. The Q&A will be helpful later for CLE confirmation. We will try to take questions during the webinar, but more likely than not, we will have to address your questions after the webinar, and we will address all questions to all participants. So please take advantage of that option. Please note today's webinar will be recorded and circulated to all registrants via email after the event. Should you have follow-up questions at that time, please reach out to any of the key contacts listed in the email communication. Dentons can only issue CLE credit for attendance during the live broadcast of the webinar, not for the recorded session. Participation on the live webinar must be on a computer or laptop device. Credit is not available for joining on via a mobile device. One other important note: if you are an attorney licensed in New York, please be sure to listen for the code word that will be given during the program. When prompted, you will need to enter the code word into the Q&A section of your screen. If you don't have a license in this state, you can disregard this. And with that, I'd like to turn it over to to David to discuss our topic of facilities restructuring and government contracts. Thank you.
Great, thanks, Steve. Appreciate that, and thanks for everyone for joining us today. So yeah, Steve was saying we're going to be talking about facility restructuring, and in particular the GAAP implications given the change in ASC 842 or to 842 from 840. So we'll be covering that, and then the FAR allowability considerations. We'll touch on some DFAR as well, and a little bit of CAS too. Then we'll get into scenarios specific to leases. We'll be spending quite a lot of time on leases. We've got the sublease, abandonment, termination, blend and extend, and idle facility. We'll talk more about each of those in great detail. And then for non-lease costs, we'll be talking about those other restructuring costs there. All right, great. So there are a number of reasons why companies might restructure their facilities. Certainly over the past years dealing with COVID and all that has done to change the remote work environment on our side, just from a consulting perspective, been helping a lot of companies out with lease restructurings. But in addition to COVID, another common one would be mergers and acquisitions, and the other couple that are listed here, I won't go through them all, but yeah, we can go to the next slide. Great. So when a company is thinking about doing a facility restructuring, it will be important for them to consider certain key points. And we've listed a significant majority of those here. The importance of that is you want to hit these points. You want to have a plan that addresses each of these points. And your documentation should also address each of these, so that when the financial statement auditors come in, a company will have that support that will, again, support their entries, their GAAP entries in their books and records. I'm not going to go through every single one of these. I think many are pretty straightforward, but for example, number 2 there, review lease and related contracts for each facility to identify termination, modification clauses, and subleasing restrictions. So when it comes to terminating a lease or subleasing a lease, it'll be important to read the lease agreement that you have to ensure that you know exactly what you can do and what you can't do. And that obviously has implications on how you record things in the books and records. Another one, number 5 there, prepare targeted closure dates and suggested timelines for each affected facility. That's really important as well when you think about when you might book an impairment to the lease, and the type of situation you have. Is it just a general impairment, or is it more of an abandonment where you would be taking the value of the right of use asset down to zero? And there's a difference in time as to when you might book that impairment depending on the situation. So understanding those dates is pretty critical. But as I said, I'm not going to go through every single one of these, but this is a good list to go through as you're thinking about planning for a restructuring. And the output of it, the documentation, will be very supportive of your gap position with the external auditors. And it may even be supportive of eventually FAR allowability and supporting your costs on that side too with the government auditors.
Okay, I look at my task today to try to bridge the gap between David and Charles's discussion of how to address and the controlling guidance with respect to gap and how it bridges through to government contract cost accounting. One of the first concepts that are probably worth talking about to make sure we have everybody on the same page is that facility restructuring, the topic of today, happens in many different contexts, but there's one special context that's relevant for government contractors, and that's a external restructuring. External restructuring is an event where a government contractor is involved in some sort of corporate transaction, M&A, divestiture, other type of transaction where pursuant to that transaction, there's a number of different restructuring activities that occur. That's defined in the DFARS as an external restructuring. When external restructuring costs that are related to that external restructuring are unallowable for government contract cost accounting purposes, unless and until certain contingencies are met. And one of them that many are familiar with is that the restructuring cost ratio to the cost savings anticipated to be reflected by the new organization going forward after the restructuring is outweighed by the savings of that restructuring. You can see some common examples of external restructuring costs that end up being captured, usually accumulated as external restructuring costs in one of these transactions. That's personnel location, severance pay, retirement incentives, sign-on bonuses. Importantly, to our discussions today, equipment relocations, facility closings, and lease terminations. Another important point related to external restructuring costs for government contracts is that CAS, the cost accounting standards, also has a related, a relevant term for external restructuring. It allows a one-time grace period, if you will, for cost accounting changes that occur as part of the external restructuring costs that are done in accordance with statute and the external restructuring requirements, and that renders compliant cost accounting changes due to the external restructuring activities not subject to increased cost adjustments on contracts, and that's an important element of external restructuring. So that, to bridge the gap, this is one type of instance, an event that can generate a significant amount of facility restructuring. Next slide. Restructuring and reorganization, another concept to try to bridge the gap here is that restructuring is different from reorganization. Organization and reorganization costs are typically unallowable. They can be viewed by government auditors and investigators as expressly unallowable in our experience. And the difference, obviously, is between the two is the restructuring costs of dealing with the operations of the company and expenses that are derived from changes made to the overall to the operational structure. Reorganization or organizational costs typically relate to the corporate structure or financing of the company, and those costs related to those activities such as attorney's fees, incorporation fees, accountants, brokers, etc. in the planning or execution of those corporate changes are unallowable. So it's an important concept to keep in mind when you're looking at these costs and trying to determine which of these costs are restructuring, which might be susceptible to being viewed as unallowable organization costs. It's important to distinguish between the two. Next slide, please. David, let me invite you back to share with the discussion of relevant gap for facilities restructuring.
Yeah.
These ASCs that we're going to go through, these are the current standards, and we're going to talk a little bit more about why older gap is still relevant to government contract cost accounting for facilities restructuring. But David, could you set us level here on what is currently out there?
Yeah. Yeah, I'd be glad to. Just starting from the top, you have ASC 360. This has been out there for some time, dealing with PP&E. But the importance of this as it relates to leases and the discussion we're having today on restructuring is that it handles impairments. So when you look at ASC 842, that is the new standard that we've referenced a few times now. That is what deals with your typical lease transactions, including modifications and terminations, but ASC 842 sends you over to ASC 360 when it comes to impairment treatment. So that's important to know. Then as you go down to ASC 420, this is dealing with those accounting transactions that are non-lease. And we'll be talking, as we've said a couple of times, we're going to be focusing heavily on leases rather, due to the significance of it and the complexities that surround it. But we'll also be talking about those types of costs related to restructurings that'll fall under ASC 420.
Next slide, please. Okay, rounding out the bridging process, there's many cost principles. These are some we selected for purposes of this webinar to get everybody familiar with these cost principles that are possibly or maybe clearly going to be relevant to your restructuring or external restructuring activities. The first one, I could go through all of them. I will select some for everybody to be familiar with. For example, we add credits because in some cases the government seeks recoupment of allowable expenses previously reimbursed when and if, for example, there's a gain on an asset disposition, the government might seek credits. Cost of money is the imputed interest on capital investment, and it can have some involvement in restructuring. Depreciation, the cost principle -11 governs depreciation on tangible capital assets and actually also includes guidance on amortization of capital leases, which we'll talk about in a second, which capital leases is no longer a current gap issue. It's a previous gap issue, I would say, that is still incorporated in the cost principles that we'll talk about in later slides. The next one, gains and losses, that limits the acceleration of depreciation expense or the acceleration of amortization cost from capital leases and so forth, and it addresses the allowability and what can be recovered and what can't. This is very relevant for some of the discussions on the lease options for right of use assets that are going to be coming up in a moment. Idle facilities addresses facilities that are not currently useful for operations, and it limits or it renders those costs unallowable unless the idle facilities are reasonably acquired and reasonable for retaining for the expectation of future use, and it's usually limited to a year or two, or by some agreement with the government contract customers as to how much continuing idle facility costs will be allowable. Rental costs address operating leases, which again we'll get into a bit more. Termination costs talks about the costs that are recoverable in the context of a termination of a government contract, large or small. Typically larger government contract terminations will involve facilities restructuring, like lease terminations and other items that we're going to be talking about today. Goodwill, that's just thrown in here to make sure folks understand that goodwill expense, write-downs to fair value and so forth are essentially expressly unallowable in government contracts, just to remind everybody. And the last principle, asset valuations, reminds everybody that even if you're involved in a transaction that would permit or require the step up of the basis for tangible capital assets from its current book value, that step up costs depreciation on that stepped up basis is unallowable expense. That's it for that slide. Next slide. All right, just to again round out and try to bridge, CAS addresses cost measurement, assignment, and allocability. The FAR cost principles we just talked about overlap to some degree, but they address allowability of costs. So for example, a FAR cost principle might include in it some measurement, assignment, and allocability guidance to determine whether the cost is allowable. CAS addresses only and exclusively measurement, assignment, and allocation of costs. And when it does hit on a topic and does address that topic, it is superior to FAR and other guidance with respect to those three issues: measurement, assignment, and allocability. Relevant for today's discussion is CAS 404, 409, and 414. Because we don't have unlimited time today, let me just say that the government often uses CAS to attempt to extract cost adjustments under fixed price contracts, even where those fixed price contracts, for example, did not bear unallowable cost reimbursement because they're fixed price. You're paid a fixed price. The government sometimes seeks to reopen fixed price contracts by alleging ordinary allowability issue is in fact a CAS non-compliance, which would allow for a cost adjustment based on CAS. And for example, one case that comes to mind that's relevant today is a case that I handled some years ago, the Excelis Inc. case at the Board of Contract Appeals, where the government alleged that a capital lease for what violated CAS 404. In that case, the board found, I think correctly, that capital leases were not governed by CAS at all, because CAS applies, CAS 404 and 409 address only tangible capital assets held by a contractor. But that's an example of how CAS might also be relevant to some of these discussions, particularly in the context of an audit. David, did you have a point you want to make?
No, I don't think so. Not at this point. I guess maybe it's worth noting, since you asked, I guess CASB sent out a proposed rule with regard to the lease standard and asked for comments. I think the comments were due in late August, and as it related to CAS 414 and 417, facilities capital cost of money, they were proposing, I think commenters are in somewhat agreeance, that the right of use asset should be excluded from the calculations within FCOM. So it'd be excluded from the definition of a tangible and intangible asset.
Next slide, please. Okay. Government contractors must claim only allowable costs under flexibly priced contracts and must include only allowable costs and cost proposals for non-commercial fixed price contracts. That's a fairly well-known requirement of government contract cost accounting. Generally, the costs of rent payments made under operating leases are allowable to the extent they are reasonable and compliant. And as we're going to talk about a bit more, generally, tangible capital asset costs that are capitalized and then thereafter depreciated pursuant to CAS 404 and 409 are allowable, generally speaking. And with respect to capital leases, which again, we'll talk about kind of the oddity in government contracts, that it harkens back to the capital lease, operating lease dynamic. Capital leases, generally speaking, the amortization expense after having capitalized the lease is typically allowable to the extent reasonable and compliant. Next slide, please. Okay, here's where we talk about that somewhat odd situation where government contracts, FAR and CAS and so forth, haven't completely caught up with GAAP, and that is ASC 840 was, I think David mentioned this earlier, was superseded by 842 in 2019. It became effective in 2021. Nevertheless, the FAR cost principles that I've raised, some of those relevant cost principles, still incorporate directly into the text of those cost principles ASC 840. And under that GAAP standard, there is a distinction made between leases that are operating leases that are not considered financing, essentially a financing arrangement for the purchase of the asset, versus capital leases, which is considered a financing arrangement for the purchase of the asset, at least sort of in a hypothetical accounting situation. It's not actually a purchase. As I mentioned in the Excelis case, the board was quite clear that it did not view capital leases as actually tangible capital assets that were purchased, but it is akin to a purchase and sale agreement for an asset. Next slide, please. Okay, talk a bit more about this. Capital leases are governed by the depreciation cost principle, which is interesting because, again, it's not really depreciation, it's more amortization of a capital lease, but it is governed by that cost principle, and it means that the capitalized value of such asset must be amortized over its useful life and charged as an expense, and that's the limit to what is allowable with respect to capital leases. Since capital leases are treated akin or like tangible capital assets, contractors can charge amortization costs on capital leases. One thing I want to note here is just kind of a trap for the unwary. Many of you are probably already aware of this, but one thing that, to be clear, is that lease transactions between related companies, related entities are, for example, do not change the nature of what is allowable for government contract cost accounting purposes. So, for example, if one entity leases to another entity a portion of its space at a certain rent cost, it may well be that rent cost is not entirely allowable on the lessee's government contracts, because the related lessor has a certain depreciation or capital lease amortization amount that would serve as a limit to what can be recovered by the lessee. And it's just something to keep in mind, because it's an issue that has come up a few times over the couple of decades, that related transactions between companies leasing either tangible capital assets or right of use assets. There are restrictions on what can be rendered allowable, and essentially those restrictions will limit the amount allowable to the lessor's expenses, typically. Next slide, please. Okay, impairments of leases. This is something that I think Charles and David are going to talk a lot more about, but in general, the impairment of a right of use asset like a lease is the expense, the accelerated depreciation or the accelerated amortization expense that occurs in the case of an impairment is typically not allowable in that year that it occurs. It is very likely that it needs to be addressed on GAAP and the financial records appropriately, and accelerate that expense and recognize that impairment. But for government contract cost accounting purposes, it is likely not going to be allowable in total, at least in that year. Instead, the way I like to talk about it is the government typically would rather not recognize that the impairment has occurred. So if you continue to have an amortization schedule or depreciation schedule, or then that may allow you to continue to recognize allowable government contract costs over time for that asset, but you would not be likely entitled to accelerate it for an impairment. I think I'll leave it at that. And David and Charles, if you don't mind continuing to expand on that issue as we go, I think that's an important note for folks to take away from today's call.
Yeah, absolutely, Steve. So we're going to go through, as mentioned earlier, we're going to go through a number of scenarios and talk further and peel back the onion a bit on the implications between ASC 840, 842, and then the allowability of those costs based on all that we've discussed thus far. So we're going to talk about a sublease. I think this is the most common situation that we find. So we'll get into that. In this particular example, it's also going to be an impairment in addition to the sublease. We'll talk about early termination and hit on termination penalties, which are common. We'll talk about abandonment, which is effectively very akin. We have idled facilities here. It's very akin to an idled facility. It's where the company no longer is using facility. There's no one in the facility at all. So that would be abandonment. And then what we're calling a blend and extend situation, which is effectively where there's a renegotiation of the lease term because the company's not using all of the square footage. So they reduce the square footage, but then they extend the period at which the lease covers. And I mentioned idle facilities earlier. So if we can go to the next slide, I think I'll get us started here with the scenario fact pattern. So all the scenarios that we have are predicated on this information. A facility of 15,000 square feet, lease term of 3 years, early termination option at the end of year 1 in a right of use asset of 330,000. And effectively that amount is determined by taking the present value of the lease payments, which in our example, and you'll see here in a second, is 375,000. One other thing that I would mention is that the numbers that we're using are pretty round numbers. And as we actually go through the examples, if you were to do the math, you would likely, for example, find a difference between the right of use asset value and the lease liability. But again, for purposes of trying to make this easily understood and to hit some key points, we have kept those amounts the same and we've kept the numbers round. So just bear that in mind as we go through this. Charles, next slide. Okay. So before we get into the various scenarios, this is our standard lease scenario. At the top box there hits on pretty much what I just described. There's an interest rate there. We will not overly focus on the 6.5%, but of more importance, I'd like to draw your attention to the bottom box there. And on the left side of the chart, it has what the particular amount relates to, the ending balance, what it relates to. So you have cash lease payment, then you've got income statement, the periodic lease expense, and then the balance sheet, right of use asset, and lease liability. So this is all under ASC 842, and you notice some initial differences when we talk about this. Obviously, now we have a right of use asset and a lease liability for an operating lease. That's new. The other thing that may not be as apparent is if you look at the cash lease payment and the periodic lease expense, in this particular case, they are not the same every year. Under ASC 840, your cash lease payment, and that payment being required by the lease agreement, that would equal the expense that hits the books and records. That's different under AS, or can be, not always, can be different under ASC 842. And the reason for that is the example that we have here, where you have an escalated per year amount of lease payment. From 120 to 125 to 130,000, whereas the periodic lease expense is based on a straight line amortization calculation using the total lease payments. In this case, 375,000 divided by 3, and it's 125,000. I just mentioned that because it is a difference. It's a difference when you think about FAR and what actually is getting charged through to the government in year 1 and year 3. They're going to be different from a timing perspective. In total, it's the same, but the timing may matter depending upon the various facility restructurings that companies are thinking about, whether it be an impairment or an abandonment or those kinds of things. So just wanted to point that out. But this is the standard lease that we'll be basing the scenarios on. Charles, next slide. Okay, thank you. So this is the sublease timeline. Again, we're talking about 3 years at the end of year 1. The company intends to sublease. They also do an assessment of impairment. In year 2, they implement and execute that restructuring. So they begin to sublease at the beginning of year 2, and they book the impairment at that time. And then the lease expires at the end of year 3. So effectively here, you've got an instance where the company's not going to be using the facility in year 2, so it's empty, but they are going to be able to receive some sublease income that'll counterbalance some of those quote unquote losses, if you will. But when they run the test and go through the judgments required to determine whether there's an impairment, there is, because the sublease income is still not enough to materially recover the costs that they're paying via the lease payments. And effectively, when you look at this from a carrying value perspective to the fair value, the carrying value is still much less, even keeping in mind that that's sublease. Next slide, Charles. Okay, great. So the left side of the page is what we went in this as in the standard lease a couple of slides ago. And the right side is the new treatment given the sublease and the impairment. So you'll notice the cash lease payments, they are the very same. The sublease cash recovery, again, they began to sublease the space beginning of year 2. So that's 60,000 for each year. And then you'll notice in year 1 that they've impaired the facility down to its fair market value. So there's $102,000 there. So from a allowability perspective, as Steve was talking about earlier, that 102,000 is likely unallowable and will not be able to be charged through to the government, given that the facility is idle beginning in year 2. And so you probably have, as Steve was saying, commonly the government, if a company meets certain conditions, can still charge through the cost of an idle facility for roughly a year, and sometimes it can extend beyond that. But for purposes of talking about this, let's just say it's a year. So the company could likely recover the $72,750, but the $75,250 maybe not, because of the out of facility. One other thing I was just going to mention here is that since under the old standard, under ASC 840, you've got in year 2, you would typically be able to charge through that 125,000 of lease expense less the amount of recovery from the sublease. So you'd end up with roughly being able to charge the government for 65,000. It's just interesting to note that here you have a lease expense of 72,750. I guess I could see a case where the government would want you to reduce that 72,750 down to the 65,000, given what I just described. And I don't know, Steve, if you have any comments around that.
I do have some comments, and that is that I'm really happy we have the guests on the phone to see how complicated this has unfortunately become, even more so than before the changes in GAAP, is that there's almost at least 2 sets of books, maybe 3, that you have to consider when you're dealing with your government customer. You have to obviously follow the current GAAP. You have to also apply the previous GAAP so that you can then determine the appropriate amount to charge the government, and to recognize in your cost claims to the government. So I think, David, in this example, a reasonable person might say, well, you know what, the government only looks at and incorporates directly the old GAAP. So this is an operating lease, so it's generally the cash lease payment amount expense per year that's allowable. And putting aside the idle facility issue for a second and just assuming that it's not entirely idle and it's still being used, the contractor might make a reasonable decision to expense the 120, the 125, the 130 as an allowable government contract cost. That said, going back to the slide with all those FAR cost principles on there is a credits cost principle, and it requires the recoupment of credits related to allowable government contract costs. So for that reason, and likely many others, you couldn't charge the entire operating expense rent. It would have to be reduced, in this case, by the 60,000 cash recovery in those years. If you were to follow a reasonable person following the current FAR would harken back to the old GAAP and apply the operating lease rationale, and here you would have another set of books for the government contract cost accounting purposes. So I guess my overall comment, David, is there's a lot to keep track of, and that's what we're trying to do here, is to try to make sure everybody's aware of all of how these all interplay with each other, especially when you have government contracts.
Yeah, thanks, Steve. I think that's exactly right. There are many more moving parts right now, and yeah, I think there's just some good thoughts around what needs to be
until they're reconciled. This will continue.
Yeah. But I do. I mean, I agree. It would seem reasonable to stick with what was being done under 840. That is what's currently in FAR.
Right, but that again requires at least 2 sets of books and a lot of extra off books memo record calculations for our clients.
Yeah, absolutely. Okay, Charles, next slide.
All right. I'm going to take over from here on some of the other scenarios, from termination all the way down to idle facilities. So the next one I want to cover here is a termination. This is another common provision when you're doing a restructuring plan. You might just want to cut the whole facilities entirely. You're able to get out of them. You're your contract contains a provision that allows you to get out. So similar to the other example, at the end of year one, we're going to have our intent to terminate the facility. And then at the end of year one, we're going to exercise that termination option. Now, instead of a 3-year lease, we have a new expiration date at the end of year 2. So there's a whole third year that we're not using anymore. Another concept is that frequently leases contain some kind of termination penalty. If you think of your house lease and everything, 3 months of rent, these numbers can vary. They can vary wildly, and also you can also end up negotiating them out. But assuming that you're going to pay this penalty for GAAP purposes, you're going to recognize that when it's occurred, and that's oftentimes would be at the end of year 1 when you notify them. And then one thing to note is that you can also, along with all these subsequent scenarios, you can impair a facility prior to any of these other events happening. So let's say maybe using 50% of the space, you can impair this prior to exercising the termination, but we're not going to confuse the issue by merging multiple scenarios together. But just keep in mind that there can be extra complexity added on top of this. Once again, we have the baseline scenario off to the right or off to the left, and then off to the right, we have our termination scenario. As you can see, the differences are we're no longer making a payment in year 3, and we will no longer have expense in year 3 because we are completely out of the facility. My year 1 and year 2 cash payments and expenses remain the same because I'm still going to be in them until the end of year 2. But now we also have a timing difference of the expense for my termination versus when the cash payment is made. For GAAP purposes, I would recognize this at the end of year 1 when I've notified the landlord of my intent to vacate, and my cash payment will come out some point in year 2. Another thing is that we've now, because of this, basically need to renegotiate our right of use asset. So that will now amortize down to 0 by the end of year 2. You effectively accelerate the amortization, so that's now 0 by the time that you're out. And we would have no more right of use assets for year 2, by the end of year 2 and into year 3. Now, Steve, if you have any additional comments here.
My comment is that if the termination penalty is, you should look at that for possible recovery, I guess is what I would say. And the other comment, this is offhand Steve's opinion, is that the FAR cost principles tend to encourage, I know this sounds odd, but encourage this type of drastic contract lease termination than it would for something like the later examples we're about to talk about, because in this case, the contractor very well could completely recover as allowable costs the cost of the termination and the lease payments in the year that they occur. In the later examples we're about to go through, all these other very reasonable business decisions, I wouldn't say you're penalized, but certainly the cost principles don't encourage other scenarios we're about to go through. In this case, the cost principles tend to be less punitive in a termination of a lease scenario. I'd say it that way.
I'd also say this is one of the more straightforward ones when it comes to accounting.
Right, that's right.
Yeah. All right. I think we've got your code word here. Your license. New York.
Is it right already? Okay.
Yeah, already there.
New York lawyers. Are you ready? The code word is facilities. Facilities is the code word, and please type that word into the Q&A box of your presentation so that we can make sure that you get credit in New York for the time you spend with us today. Thank you. Next slide.
All right, the next scenario I'm going to cover is an abandonment. This is effectively a full impairment down to 0. We are getting no more value out of the facility. We are still going to end up paying for it for the full 3 years, but for our purposes and for the purposes of 842 now, we've had a right of use asset that we're not getting any value for. Once again, in the end of at the Q4 year 1, we have our plan. By the end of year 1, we have completely ceased use of the facility. Now we've got 2 years of it just sitting there. One important thing to note is that in order to abandon a facility for GAAP purposes, it's very important that management does not have the intent or ability to sublease. If there's any possibility that you can sublease this and you have the intent to do so, you would actually impair this instead down to what you could potentially recover from a sublease. Income is one common method of doing that valuation, but you cannot go to zero because there is still a potential for you to use this. So that's one important caveat to this whole abandonment. You have to be completely out. So we'll go there. Once again, the standard lease on the left and the abandonment on the right. Once we have done this, as you see in year 2, we've made our decision at the end of year 1. We impair this thing for effectively the entire value of my right of use asset. That is going to go to 0 all at once. I'm out of the facility by the end of year 1. Year 2, it's completely abandoned. So my right of use asset does not go down. Now, one thing to notice, I still have a liability. I'm still required to pay for my lease. So my liability will actually stay in year 2 and trail into year 3 as I'm making those payments. Once again, also I have cash payments year 2 and year 3. Now I pulled forward all that expense, and my year 3 expense is effectively calculated as the difference between my cash payment and my remaining liability at this point. So you can see there's a very big difference in the expense here between this and the sublease scenario for year 3, and even the standard expense in year 3. Once again, it's very important that you make that decision that you cannot have any alternative use effectively for the facility and no ability to sublease.
If you don't mind a quick comment here, this likely makes a whole lot of sense for companies to do, to recognize to recognize the lack of use or the lack of usefulness of an asset, and to match the expenses with revenues and so forth. It's not ideal, likely, for government contract purposes. It's not recognized. The the cost principles don't recognize the most recent gap. Everything would be much easier if it did. But what I think that contractors should pull out of this is that this is a potentially very appropriate business decision to make for purposes of financial accounting and operating your business. The likely way this would be addressed in government contract cost accounting is that the abandonment would simply render the facility idle, and you'd be having a discussion about whether or not the costs of year 3 are allowable as part of an allowable idle facility costs or not. That doesn't mean they're for sure unallowable, but that you certainly will have to address this in a different way, or especially with your government customer, this scenario.
Yeah, and I think you had a slide here that just kind of covered some of those points.
Right.
Yeah.
You can go to the next slide, I think, yeah.
All right. Now, there is one other thing for GAAP when it comes to abandonment. It's the timing of your abandonment. So financial statements issued at year end. So on the top here, we have basically our intent to abandon and our actual abandonment all occur within the end of year 1. My impairment can go to 0 then, and I will have just the lease expense, as I discussed, calculated earlier as a function of the payment and the liability, but there will no longer be any right of use amortization. Now, if I have a plan to abandon and I'm not able to vacate the premises for, let's say, 6 months, I cannot abandon or I can't impair it to 0 right away because I still have 6 months of value. So the two methods that can be used is, once again, you can kind of mix and match. You could impair first based on the sublease, and then you would accelerate your amortization until the end of the lease term, or you could just accelerate the ROU amortization until it's 0 by the end of year 2. I think those are the two options. I think depending on the timing, if it's a longer spread, it might be worth it from a business standpoint to impair first and then accelerate the remaining amortization. Or if it's a relatively short time afterwards, 1 month, 2 months, you probably can just straight up accelerate the amortization. This is just a business decision and have to be documented from a GAAP standpoint on why you chose one versus the other and the materiality. But just wanted to point out there's a timing issue with abandonment, is that you cannot go to 0 until you're out. All right. Also, one thing to point out with both the termination and the abandonment, there's some additional restructuring costs that you're more likely to incur for those two scenarios than the others. And those are things we'll maybe touch on a little bit later, but it would be terminations of employees, severance pay, relocation expenses, because you're actually effectively leaving those facilities. These are things that you're more likely to incur than maybe just subleasing a portion of it. And so there are kind of specific rules on when those things are incurred from a GAAP perspective and the timing of when those losses can be recognized. So just keep that in mind, that there are a lot of other costs that go into the facilities restructuring plan, as Steve and Dave mentioned earlier, than just the lease itself. There can be a lot of ancillary costs there too. One of the last scenarios we're going to cover here is a blend and extend. This is a lease modification, as we discussed earlier. Another common technique is to try to renegotiate my lease. I still need it. I don't need to be fully out of it. I don't plan to sublease it. I just want to give back some of the space back to the landlord. A very common scenario is that I'm going to reduce the amount of space, cut my lease payment for just the space that I'm using, and relinquish that old space back. And probably a lot of times these are also accompanied with an extension of my lease term out to a couple more years. So I'll have a lower payment at more years. Although keep in mind that these are lease modifications. There can be any number of, depending on the specific negotiation, these terms can be wildly different. But this is a common one. So in this case, after those negotiations, I'll now have a lower rent, but for more years. And once again, you can mix and match. You can impair prior to doing this modification. All right, so we have standard scenario on the left and the blend and extend on the right. As you can see, there's no impairment in this case, but I've effectively renegotiated my lease. And at the end of year one, I now have a new right of use asset based on the present value of my new lease payment structure. It still will escalate, $63,000, $65,000, $68,000, and my periodic lease expenses straight lined across that period. I could see one issue here is that, your contract ends in year 3, but you still now have this facility for 2 more years. Obviously, you can't recover things when you're past your contract, but this is just basically extending out my lease. There's no impairment considerations here unless you're mixing and matching. So just like I said, one other common business motivations for doing it this way versus the others. Anything from you, Steve, on this?
I think you already kind of stole my point. Is that it's punitive in the sense that it's perfectly reasonable to do this, but if the government contract has ended or there's reason why extending it wouldn't be ideal. You may have difficulty recovering the costs and beyond the 3-year period, but no, this is no additional comment.
Yeah. All right. I think, like you said, once again, there are additional impairment considerations. In your facilities, you'll have other fixed assets. You may have done leasehold improvements to the building that no longer have the value that they once had. There could be furnitures and fixtures, equipment that is there that will have to be a management decision on what to do with that, whether you're going to dispose of it by either scrapping it, abandoning it in place, or selling it to a potential sublessor or to another third party. Frequently, they might have rows of cubicles in half the space and they're not getting used. So is there any GAAP value to those? They're yours, but you don't have any value to them. So a decision have to be made if any of that related PP&E would have to be tested for impairment separately and impaired frequently to 0 for a lot of these, although it could be a different value depending on how that assessment turns out. And then we have our idle facility. For GAAP purposes, there really is no difference between an idle facility and abandonment. They're effectively one and the same. The GAAP doesn't really recognize a term of idle facility. It only has a term for abandonment. So the scenario is just going to be an abandonment example. You're going to do your impairment at the time that you've vacated your premises to 0. And you'll have remaining lease expense. So from a GAAP perspective, there's no such thing as an idle facility. You're either in and impairing or completely out and impairing to 0. So.
All right, I think I have the next slide, and this is just to go in a little more detail what the idle facilities cost principle says. The cost of idle facilities are unallowable unless the facilities are necessary to meet the fluctuations in workload. And in the case of abandonment, the company has identified that it is abandoning. So there is no necessary future fluctuations in workload to talk about. Was necessary when acquired, possibly, and are now idle because of changes and requirements, possibly. So you might want to look and see if these costs are because of a termination of a government contract. That might be something to look at. But these are the requirements to render idle facility costs allowable. And typically, if you can make good arguments under those first two elements, you have sort of a per se or prima facie case for allowability of the cost for one more year. And it would be nice if every lease was 3 years, like our sample lease here for purposes of this Government Contracts Academy, but they're not. Typically, these are long-term real estate, commercial real estate leases that go a lot longer than 1 year. So 1 year is probably not enough. And it is, in the case of abandonment, not going to likely be considered an idle facility if there's not a necessary future workload fluctuation anticipated. So, but if there is, of course, you can show that it should be longer than 1 year. It would be reasonable. Then it's possible to continue to seek recovery of the ordinary depreciation or amortization of your assets and right of use assets beyond the period of time that you've already, for GAAP purposes, expensed the items, accelerated the expense and recognized impairment. That is, I think, it. Anything else on that, Charles and David?
No, I think just like I said, the from the GAAP definition of abandonment, it would be difficult to say that I'm going to come back to the facility, in 2 years and restart production, because that would have to be taken into account with my initial decision to abandon. Because then, if not, I could see a potential use for it, and I wouldn't impair it to zero. So I think, kind of by definition, it would make that a difficult justification. Not impossible, but I think it would be a difficult one.
Again, a lot of this is because of the lack of reconciliation of reality of the gap that currently applies and the government contract cost principle. So it makes the folks on this phone and other folks within our clients' organizations' job more complex to have to look at all of the different elements of any business decision on how to deal with facility restructures.
Yeah. All right. Like I said before, there are other restructuring costs besides the leases that you may incur as part of restructuring plan. Frequently, there are non-lease contractual expenses that are associated with abandoned or sublease facilities. These, for GAAP purposes, you can accrue in the period that you have made your intent clear for the plan. And these are going to be very common ones. Are going to be your termination and everything. So you'll accrue those when you make the termination penalties. You're going to accrue those when you've incurred them, like when you've notified the landlord of the execution of your termination provision. The next bucket of kind of expenses are your lease-related contractual expenses. These are going to be commonly your CAM, common area maintenance, taxes, insurance. These are contractually obligated as part of your lease payment. From a GAAP perspective, you can pull all these forward up to the point where they are being taken over by your sublessor, if you have one in this case. So, for example, if I've got a 6-month delay between my plan being executed and a sublessor coming into my space, I can pull forward for GAAP purposes, January, February, March, April, May, and June of these contractual related expenses, expense them at the time I make my intent clear, and then they will be picked up by the sublessor. It's fairly common that the sublessor picks up some of those charges as part of their agreement. For abandoned facilities, you'd be able to pull all of these lease-related contractual expenses forward at the time of that decision. So another cost here that might have a difference in timing from the GAAP perspective and with the cost accounting perspective, that's related. It's ancillary to the lease. It's not for the building itself, but these are lease-related contractual expenses. And then you have non-reoccurring expenses as part of ceasing use of the facility or any number of things. These can be broker fees that you pay to the real estate agent for finding the sublease or determining your fair value of your sublease income. There can be other certain exit and disposal costs of moving equipment, cleaning, changing of locks. There can be IT related transactions that go on, for badging and things like that are incurred. From a GAAP perspective, these liabilities are recognized when incurred. These are not pulled forward typically. And then you also have those one-time other benefits, I think severance, termination benefits. These are going to be incurred for GAAP purposes when you've communicated to the employee that you've made a promise effectively that you've incurred that liability. So once again, there can be many other costs besides just the straight lease payments that may have to be considered for allowability and everything too. So Steve, I don't know if you've got any more color into that.
No, it's an area that requires a deep dive into both. You really have to look at them separately and make sure that you understand the government contract cost ramifications of any business decisions made in this area.
All right. And then, like I said, the exit and restructuring costs, most of those fall under the ASC 420 standard, in which you follow the GAAP rules for liability recognition when recognizing your expense for GAAP purposes. And then, like I said, these restructuring expenses are usually on a broader strategic level. There's a reason why the company is executing a company-wide facility restructuring plan instead of just one-off locations, is that there's a broader shift going on within the company. Keep in mind that a plan does not mean that all the facilities have to be treated the same and that all of them have different timings. So a plan might be expected to take place over the year, but facilities 1 through 5 may have different timings and different treatments depending on how you do them. A company may choose to abandon one facility, sublease another, and terminate a third. So a broader facility restructuring plan can incorporate multiple scenarios within just that single plan. All right.
Okay, yeah, Charles, I think I was going to cover this, and I think this is the next to last slide before questions. Yeah, and I think, Steve, you made this point earlier. The main point here was that the facility restructurings that we're talking about are not the same as dealing with an external restructuring under the DFARS, and that's a result of M&A activity, and there are specific requirements with regard to those restructurings for allowability. You got into most of that earlier, so it was just a slide just to make that point.
And I think one thing I just want to close with is remember, we did simplified examples, but these can be very complex transactions that a company would want to go through. So just keep in mind that there can be a substantial amount of time that needs to be dedicated to determining all of these transactions, and that to factor that time into the plan itself, because it may take months to vacate a premises, and your accounting needs to follow that timeline of when that's actually expected to incur. These transactions do not happen at the snap of a finger. And so the timing of these is very important to consider with the overall plan and when to recognize these transactions as occurring. So just wanted to wrap that up.
Yeah, I know we're close on time, but Charles, that's a great point. You really can't understress the value of the plan and going through those key critical points and that assessment and documenting it as early as possible.
I see one question from Brian Rose. I think, Brian, we may have answered the question during the webinar today. I think I might have touched upon this idea of going beyond 1 year of the prima facie allowability for idle facilities. And I guess I'm going to direct that to David, to you and Charles. Are you seeing this excess business vacant property? Certainly I am, kind of indirectly. Are you seeing it more? 1 year is not being a reasonable period of time to hold it?
We've recently helped a client with a facility restructuring plan as of the end of 2023, and that one included two abandoned facilities. And both of those were just
Over a
in
year.
yeah, it was over a year left. So it's not unusual. I mean, it turns out that it's just like the market for these areas was just not, conducive to getting a sublessor, right? And they're like, we really don't. The broker is key here. They can help you make this decision if there's potential, but there it's not unusual for these transactions to be occurring. A lot of places have realized that they don't need full offices anymore. They're consolidating offices. It really depends on the business decisions for the
Yeah,
companies.
yeah, there's a lot of it out there, I think. And we've been involved in quite a bit with clients, but also just hearing out in industry, there's quite a lot of this going on. So it's very common in this day and age.
Yeah, I do think there's probably a case where some places are not impairing these as they probably should, or taking this analysis particularly seriously or timely. But I think it's something to consider from a GAAP perspective that you accurately reflect your financials for these leases.
Sure. I can't see the Q&A, but there's nothing else in the chat. But before we finish up, I just want to thank you, David and Charles, for joining us in our Dentons Government Contract Academy series. This has been hopefully very helpful and educational to our clients, and we appreciate very much our work with you over the years, and thank you for supporting our clients today.
Yeah, thank you, Steve, and everyone else for taking the time. We
Thank you.
appreciate the opportunity to talk with you today.